What if one of the most powerful financial networks on Earth wasn't built on Wall Street, wasn't run by hedge funds, and didn't advertise itself at all? What if it was built inside churches, powered by faith-based discipline, and protected by silence? Most people think billionaires are shaped by Silicon Valley code, oil empires, or government contracts. But behind the scenes, a quieter force has been compounding wealth for decades, a system rooted in religious structure, collective discipline, and long-term financial patience. Today, we're exposing how Mormon-linked wealth networks quietly reshaped philanthropy, ethical investing, and global capital flows, not through flashy headlines, but through strategic invisibility. And the strangest part, this system didn't start with money, it started with belief. To understand this story, we need to zoom out. The Church of Jesus Christ of Latter-day Saints, often called the LDS Church or Mormon Church, is one of the most organized religious institutions on Earth. With millions of members globally, it operates universities, media companies, humanitarian aid programs, farmland, real estate holdings, and investment funds. But unlike typical non-profits, its financial structure is highly centralized, tightly managed, and unusually disciplined. Every active member is encouraged to donate 10% of income as tithing, not occasionally, not symbolically, but systematically. Over decades, this created something rare in the financial world. A predictable, recurring capital inflow not tied to markets, politics, or economic cycles. While governments struggled with debt, while corporations faced recessions, this system kept accumulating. And quietly, behind closed doors, that capital began transforming into one of the largest long-term investment pools in religious history. But this wasn't just about hoarding money. It was about control, strategy, and influence, shaping where capital flows and how ethical investing would be defined. The roots go back to the 1800s. Early Mormon communities were forced into isolation. They learned to survive through cooperation, shared labor, and economic self-reliance. Farming collectives, community stores, mutual aid. This culture of collective economics became embedded into church identity. Fast forward to the late 20th century. As global finance modernized, the LDS Church modernized with it. Instead of keeping donations idle, leadership created internal investment structures designed to preserve and grow capital quietly, the most famous example being Ensign Peak Advisors, a reserve investment arm built to manage long-term assets. The strategy was simple but powerful. Avoid speculation. Prioritize long-term index-style growth, minimize risk exposure, maintain confidentiality, reinvest returns. While hedge funds chased fast profits, this system focused on decades-long compounding. It wasn't flashy, but it was devastatingly effective. Over time, the numbers snowballed. Annual tithing inflows created a steady stream of investable capital. Returns compounded, reserves grew. This allowed the institution and affiliated wealthy families to expand influence across real estate, agriculture, commercial development, media holdings, technology investments, global humanitarian programs. But the real shift happened when Mormon-affiliated investors began promoting values-based investing, what today is often called ethical investing or faith-aligned portfolios. Instead of maximizing profit alone, capital was directed toward businesses aligned with moral frameworks, avoiding alcohol, gambling, tobacco, supporting family-oriented brands, investing in stability-focused sectors, avoiding reputational risk industries. This created an alternative investment ecosystem. Not anti-capitalist, not but disciplined, conservative, and reputation-focused. And slowly, this approach began influencing mainstream philanthropy models. Here's where most people misunderstand what's happening. This isn't traditional charity. It's strategic philanthropy. Instead of simply donating cash, Mormon-linked institutions often fund education systems, emergency logistics, infrastructure, agricultural sustainability programs, disaster response, supply chains, self-reliance, training programs. Why? Because infrastructure multiplies impact long-term. It reduces dependency, builds reputation capital, strengthens global networks, creates goodwill pipelines. In business terms, it's social return on investment. And this is where influence grows. Governments notice, NGOs collaborate, communities become dependent on logistical support. the institution becomes embedded in crisis response frameworks. Not loud power, quiet power, but no system stays invisible forever. As global scrutiny increased around non-profit finances and mega-wealth transparency, questions began surfacing. How large were the reserves? Why were holdings structured so privately? Should religious organizations manage investment portfolios rivaling sovereign funds? Reports, whistleblower complaints, and regulatory attention forced parts of the financial structure into public view. Suddenly, the quiet strategy was being discussed in headlines. Supporters argued, this is responsible stewardship. Long-term reserves protect humanitarian missions. Financial discipline allows independence from political pressure. Critics argued, too much secrecy, too much accumulation, too little transparency for a tax-exempt institution. For the first time, the invisible machine was visible, and once the curtain lifted, it triggered a global conversation about religion, money, and influence. After financial exposure increased, internal financial reporting practices were adjusted. Public communication became more strategic, investment structures were reorganized. Philanthropy, branding, expanded. The institution didn't collapse. It adapted, just like large corporations do when regulation tightens. This is the core pattern repeating throughout financial history. When systems face scrutiny, they evolve rather than disappear. And this leads us to the bigger question. If faith-based capital systems can quietly build massive influence, who else is doing the same? A quiet financial system built not on hedge funds or governments, but on faith-based discipline, centralized tithing, long-term investing, and strategic philanthropy. But here's the uncomfortable truth. This isn't just about Mormon billionaires. This is about a new class of power emerging worldwide, ideological capital networks that don't rely on public markets, don't answer to voters, and don't operate on quarterly profit cycles. They operate on belief. And when belief meets compounding interest, the result is influence that grows silently, steadily, and globally. Now let's follow the ripple effects. If you step back and remove religious labels, something strange appears. The structure looks familiar. Steady inflow of capital, centralized management, reserve accumulation, long-term investment strategy, strategic deployment during crises. So that's not just a church model. That's the blueprint of central banking. Central banks accumulate reserves. They inject money during crises. They influence markets quietly. They stabilize systems while gaining more authority. Faith-based financial institutions are now doing something similar, but outside public monetary policy. Instead of controlling interest rates, they control humanitarian capital flows, ethical investment standards, social development narratives, education, funding pipelines. This creates parallel financial power structures that don't compete with governments. They coexist and sometimes outperform them in speed and coordination. During disasters, faith networks often mobilize faster than bureaucracies. During economic downturns, reserve funds allow continuity. And slowly, this reshapes global expectations of who provides stability. Here's the pattern financial analysts quietly acknowledge. Long-term pooled capital with consistent inflow outperforms most speculative strategies. When you combine regular contributions, tax-advantaged structures, conservative asset allocation, multi-decade time horizons, you create compounding machines. Even modest annual returns become massive over 30 to 50 years. That's why faith-based institutions and family dynasties quietly dominate asset ownership. They don't chase trends. They wait. This is how generational wealth is built, not through viral crypto trades, but through patience, discipline, and centralized planning. And that's why these networks rarely collapse during market crashes. They aren't leveraged like hedge funds. They aren't tied to political election cycles. They don't panic sell. They absorb volatility and buy quietly when markets dip. The same strategy used by sovereign wealth funds. This isn't new. In medieval Europe, churches controlled massive land wealth. In ancient civilizations, temples functioned as banks. In early Islamic history, religious endowments financed public infrastructure. Power has always flowed toward institutions that control. Trust capital, long-term planning. What's new is scale. Digital finance, global markets, and modern investment vehicles allow faith-based institutions to operate globally, not just locally. They can hold international stocks, farmland, real estate, and bonds across continents. This transforms belief systems into transnational financial actors. And once that happens, accountability becomes complicated, because they aren't corporations, they aren't governments. They operate in a legal gray zone protected by non-profit status while functioning like institutional investors. Now here's where the consequences appear. While institutional wealth compounds quietly, ordinary people face rising living costs, shrinking purchasing power, unstable job markets, declining savings rates. The wealth gap widens. Not necessarily because faith institutions are malicious, but because capital concentration always produces inequality when access is unequal. Those inside structured systems benefit from financial education, community support, investment discipline, network access. Those outside rely on fragile personal income and unstable markets. The result? Two financial realities, one built on institutional patience, one built on individual survival. This pattern isn't unique to religion. It's happening everywhere. Corporate consolidation, government debt expansion, elite capital pools. Faith-based wealth is simply another layer in the global concentration of financial power. Many governments attempted to address this through financial disclosures, regulatory oversight, reporting requirements, non-profit accountability laws. But here's the reality. Transparency doesn't eliminate power, it just reshapes behavior. Institutions adapt structures, assets move through subsidiaries, investment arms rebrand, legal compliance increases, but concentration remains. Because the core advantage isn't secrecy, it's scale. Once an institution controls billions, it gains better investment access, lower transaction costs, exclusive deal flow. Political influence, no regulation, easily dismantles that. Just like banks after 2008, they didn't disappear, they consolidated. Now let's confront the most uncomfortable question. When billion-dollar portfolios decide what's ethical, whose values win, ethical investing often excludes certain industries, certain behaviors, certain companies. But it also redirects capital to preferred narratives, approved social models, institutional priorities. This creates soft power, not through force, but through funding. Over time, money shapes culture, which businesses succeed, which ideas scale, which innovations receive capital. When belief-driven investors control large asset pools, they influence not just markets but social direction. That's not inherently evil, but it is powerful, and power without public debate always carries risk. Let's bring this story home. Mormon billionaires didn't appear randomly. They emerged from disciplined financial culture, consistent saving, long-term investing, community accountability, structured education. This proves something uncomfortable. The biggest advantage isn't intelligence, it's structure. Modern charity isn't just about helping people, it's about reputation, management, influence, building, infrastructure control, narrative shaping. When institutions fund solutions, they shape outcomes. That's not conspiracy. That's strategy. Speculative traders come and go, but institutional capital compounds across generations. The loudest wealth often collapses. The quietest wealth survives. Here's the final thought that should make you uncomfortable. As more financial power shifts into private institutions, religious, corporate, sovereign, ideological, public transparency weakens. Markets become less democratic. Opportunity becomes gated. And ordinary people are left competing in systems designed by those with permanent capital. The question isn't, are Mormon billionaires good or bad? The real question is, who controls the future when belief, money, and power merge? And are you building personal systems, or depending on fragile income streams? If this video changed how you see money, faith, and influence, hit like so this reaches more people. Subscribe for more deep dives into hidden financial systems, global wealth structures, and economic power dynamics, and comment below. Do you think faith-based investing is ethical leadership or silent financial control? Your answer might reveal more about the future than you realize.